Things didn't work out so well for Icarus when he flew too close to the sun. And if you believe some of the tales being told on Wall Street these days, AI stocks may be the next to tumble into the sea. But what if that is a myth? What if the tech sector's outperformance and the spending and CapEx boom that's fueling it is durable and likely to be long lasting too? And while we're at it, what if markets are not as overvalued as some fret and fears of private credit and bank lending risk are overblown? Joining me on this week's episode of the Money Show MoneyMasters Podcast are two experts who argue, essentially, to stop worrying. And they have a long list of reasons why. They are José Torres, Senior Economist at Interactive Brokers, and Ed Yardeni, President at Yardeni Research. Gentlemen, welcome to the podcast. Ed, Jose, I really appreciate you coming on air to talk here about what's going on in the markets. It's been another powerful year, but as we're recording, we're getting in a little bit of stumbling and probably the highest valued, highest momentum part of the market, which of course is your AI names and so on. Can you maybe just start big picture, Ed, by letting me know how the recent action, the action of the last few months, fits into your overall outlook for the stock market?
Well, I think it's still a bull market, but it's been a bit intense to the upside here. So having some pullback is a good thing. Some of the technical indicators suggest there's too many bulls around right now, and so we need to get a little bit more bearishness into the market because when you have too many bulls, it works pretty well as a contrary indicator. And I think we're seeing that. I think we've had some really good earnings coming out, but some of the stocks, particularly in the AI universe, stopped going up. And I guess that kind of convinced some of the speculators that maybe even more good news coming out of AI is already discounted and isn't going to take the stocks up, and they've already made a lot of money. So profit taking would be quite natural here.
It was interesting. You had a great piece the other day. You kind of joked about how they might be building a data center in your backyard, just given with all the announcements we've seen.
Yeah.
Thoughts on that trend, the amount of money being borrowed, spent, invested, talked about in some of these announcements. I mean, is this a good thing or too much of a good thing?
Well, it could be too much of a good thing, but the reality is we have a tremendous amount of data that we're producing all the time. And so the need to use that data and process it, store it, come to conclusions isn't going to decline. It's only going to go higher and higher. So there is a certain infinity and beyond aspect to artificial intelligence. Artificial intelligence really isn't a revolution. It's an evolution of the digital revolution, which started in the mid 1960s. And the digital revolution is all about processing as much data as we possibly can more cheaply and faster. And we've come a long way since the IBM mainframes. The AI phenomenon, to me, AI is kind of like an amazing app that lends itself to being used in all sorts of different business and personal activities. And that creates a tremendous a surge in demand for computing power to process the data that AI can in fact deal with. So I think it is kind of feeding on itself on the demand side. And every now and then we may find that we've built too much capacity, and so the hyperscalers will cut back their capital spending. Their cash flow will look better. Their profits will look better while they're waiting for demand to catch up to all the capacity they've built. So I'm not particularly concerned about that. Look, at the end of the day, AI is the people who are going to make AI money on AI are going to be the cloud providers, and they're expanding capacity.
Yep. Jose, let me pivot to you as an economist, kind of how you view the CapEx boom, the spending on this sector. I mean, is it the driving factor of the economy? Is it in the big picture of the US economy not all that significant? I was wondering if you can sort of characterize that.
Sure. So definitely been a significant driver in terms of capital market valuations. And of course, we know that the wealthier households have been comprising a greater share of consumer spending. So, from a wealth effect perspective, I would say that, AI has helped there, has helped extend the cycle. But I think that as far as the capital expenditures are concerned, we continue on this rocking chair, wondering whether the investments will deliver robust returns over time or if they'll fall short. And sometimes we see research from some providers that say that we're still in the early innings and that the runway is long and strong. But then on the other side, we hear research from other providers that are more pessimistic, that think that the profitability going forward isn't going to be as momentous. So it's really a wait and see approach overall. As far as valuations are concerned, though, I think that we're setting up in the next 2 to 3 years for a year where earnings grow 10% or 12%, but the market only appreciates 5%. And that way we can continue in this bull market while normalizing valuations. And I think that'll be a welcome event for all.
Okay. I want to stick with another sort of side effect of the AI boom from an economic standpoint, and that's in the labor market. We've had these announcements from Amazon, from UPS, from other companies where they're doing what, you never know if they actually followed through with all the cuts they announced, but there are some pretty big numbers, multiple tens of thousands of employees. Thoughts on, how that's going to impact things and how that fits into your view of economic growth for the rest of this year and 26?
Sure. So I think AI adoption has definitely been weighing on labor conditions, but I think the primary factor this year has been immigration restrictiveness. We had an open border policy prior to the Trump administration. This new administration, of course, is an extreme tilt in the other direction. So we don't have that labor supply. So that's really been hampering employment gains. And then AI has really weighed on labor demand. Add to that, even though we've had rate cuts, financing costs are still way too elevated for some of the rate sensitive areas in the economy to add to payrolls, namely small business, manufacturing, real estate, construction kind of sectors. And I think those three elements in combination have really made, payroll gains. We don't have data because of the shutdown, but I'm ready to say that payroll gains are running at around 40,000 or 30,000 or so.
Got it. And do you have any kind of ballpark or numbers that you think if we were reporting them, those are the kinds of numbers we get? Are you a little more optimistic, more pessimistic? And what are your
Well,
thoughts on the Fed here as well?
I agree with the analysis that migration has clearly had a round trip from open border to closed border, and deportations obviously have also weighed on the supply of labor. So that I think is clearly important, and also just as important is that I think everybody in business is now focusing on AI. They're trying to figure out whether it's useful, whether it can increase productivity, whether it can reduce the need for more labor. And while they're figuring that out, it seems as though payroll employment isn't growing very much, if at all. And 30 to 50,000 per month, maybe what is normal now instead of 150 to 200,000 per month in terms of the labor market. That raises the question, though, of if that's all we're going to do on the employment side, how does the economy grow? Where's consumer spending? And I think the answer is productivity will lead to wages rising faster than prices. Real wages should, I think, more than offset the slowdown in payroll employment. So I'm optimistic, and the latest data kind of, it's only a couple of quarters here, but GDP is very strong in the second and third quarters from the data we have available. Payroll employment, on the other hand, has been revised downwards. The only way that can happen is if productivity is increasing quite significantly.
Jose, you touched on earnings and off camera. Ed and I were talking a little bit about valuations. I have to ask, again, as we're recording this, there's concerns Palantir being one of the most overvalued, but also popular stocks in the market. sort of sold off after earnings. You had Michael Burry, the big short guy, coming out and talking about putting on negative positions in stocks like Nvidia and Palantir. And the Wall Street Journal published an article about the CAPE ratio being back up there in what it calls nosebleed territory. Are you concerned about the valuation that in the market overall, or in particular sectors, or do you think that we're okay because the earnings growth is there to back it up?
I think we're okay because of what you just said. Earnings growth is there to back it up. I think we're also okay because additionally, I think that we're going to change our framework on valuations. I think in the next few years, we're going to shift to the way we do forward PE on a next 12-month basis. I think that's going to turn into a next 36-month basis. And then all of a sudden, if you start comparing the earnings yield with a little more duration in stocks, you realize that when you compare the risk premium from that perspective, it's not as expensive. Justifications there is that the companies that are leading the market today are much more stable than the ones that were leading the market during the last valuation excess correction that we had back in the dot-com bubble. And then also we are, from the Federal Reserve standpoint, we're shifting away, and not just the US central bank, this is a global thing we're seeing. We're really shifting away from strictly enforcing the inflation mandates and having much currency discipline, and we're really shifting into prosperity defenders. So, the Fed cut rates twice already this year, maybe in December, with the CPI in the high twos, now 3%. That is an incredibly constructive backdrop for equities if the Fed is cutting with inflation very strong. And the reason why price pressures are so elevated, tariffs have had a very limited effect so far in my analysis. Core goods as a percentage of CPI is only roughly 20%. Really, the pressure is coming from services. It's what Ed was saying earlier. We have that strong consumer demand really driving up costs. We saw it in Trump 1.0, where CPI got up to 2.93%, only to retreat back to 2.5 to 2.4%. Like Ed was saying, when you have growth rates in excess of 3%, it's pretty easy. It's not that challenging for inflation to start to hover above targets.
Got it. Ed, anything you'd add to that sort of valuation debate there?
Yeah, I would add that you look back at the history of the valuation multiple, and it is very much dependent on the expectations of what the economy will do next. If there's widespread fears of an imminent recession, then the PE goes down for a while until it turns out that those expectations were too pessimistic. The economy's hanging in there, but earnings are coming through despite those concerns, and so the PE goes right back up. In other words, corrections are basically corrections in the valuation multiple, not really in earnings. Bear markets occur when those fears of a recession actually are realized, and in that case, you get a substantial drop, not just in earnings, but also in the valuation multiple. So much depends here on what is the outlook for the economy in terms of its vulnerability to a recession over the next few years. And I think we've learned over the past 3 to 4 years that this economy is remarkably resilient. It's taken a lot of shocks. It took the pandemic shock, the lockdown shock, the social distancing shock. Then we had the supply chain disruption shock, followed by the surge in inflation in 2021, 22. The Fed followed up with a remarkable tightening of policy from 0 to 5.5%, and everybody thought that would lead to recession. I didn't think so because I really believe that the economy would be resilient and that the capital markets would be resilient. I think the chances of a recession remain pretty low. I think we can have rolling recessions, and if that's the case, I think the valuation multiple can stay up here around 22 and I think the Magnificent Seven are going to remain magnificent. You're still going to see a handful of stocks with a multiple of over 30, accounting for over 30% of the S&P 500. and the rest, the 493, could be selling at 19, 20 times forward PE. I think that's sustainable.
Okay. I want to ask about another risk that has gotten quite a bit of press, and that's sort of what's going on in the off-bank sector when it comes to lending private credit. And Jamie Dimon, his infamous cockroaches comment on the recent earnings call. Thoughts on whether there's any of those sort of unseen risks or less visible risks in the credit markets that we need to be concerned about? And I guess that's just for either or both of you.
Well, I think most of the problems have actually been in the banking sector, and there haven't been that many cockroaches, and they've been associated with fraud. But fraud, I guess, is the ultimate failure of a banker to assess the credit quality of a borrower when you lend to somebody who commits fraud. Um, but it doesn't seem to be a widespread problem. And within the private credit market, when things blow up in the private credit market, it's a haircut to our rate of return. I mean, people own very diversified portfolios. A lot of the lenders lend to a lot of borrowers in the private credit markets, and they're sitting on portfolios of these things. And when one or two or a few more cockroaches blow up, um, the return on their investment goes down, but it doesn't create a credit crunch or an economy-wide problem.
Got it.
Yeah, and
Jose, anything you'd add to
yeah,
that as well?
yeah, I'll add to that. I mean, to your point, Ed, and the reason why private credit became such a popular asset class is because those returns were particularly elevated. So, when investors are chasing double-digit returns on credit, there is expectations for some turbulence. As far as the overall landscape, I listened to a lot of earnings calls from the private equity, private credit giants, as well as the regional banks. And it seemed like it's a few isolated cases. It doesn't seem like it's going to be a widespread issue. Not worried about it at the moment. I think we're going to be fine. And when you just reiterating the earlier point, when folks are out there lending money at 13, 14, 15%, there is an expectation that there will be some delinquencies, some defaults.
Sure. It seems like despite some of the things that have been kicked around out there, you're both generally optimistic, whether it comes to underlying economic growth or market valuations and prospects moving forward. So I guess I'd want to pivot here in the time we have left to talk a little bit about sectors or particular opportunities outside of the oft discussed AI or tech space. What else do you find particularly promising? And I guess, Ed, I'd start with you.
Well, how about the S&P 493? They've been doing pretty well. I mean, if we didn't have to compare them to the Magnificent Seven, it would still be a pretty decent bull market. It's just the Magnificent Seven have been such outperformers that everybody keeps saying, "Well, when are we going to broaden out?" Well, the reality is a lot of stocks have, delivered pretty decent returns in this bull market, not just as amazing as what the Magnificent Seven have delivered. So. Look, this AI evolution or revolution in the digital in the digital space, it's not going to be sustainable unless there are customers in the non-tech marketplace that find it to be very useful in reducing their costs, increasing their productivity, customer satisfaction, and all that. So the hyperscalers, the producers of these large language models, they're going to have to produce a product, a service that really does have an impact on their customers, and those customers are the S&P 493. I don't know if it'll trickle down to the S&P 600, which are the small caps, or the S&P mid caps, the S&P 400. The problem there, I think, is that all the really good companies get bought up by the large cap companies before they really have a chance to become the next Microsoft. It may be that simple.
Got it. Jose, same question to you, I guess. I mean, again, sort of outside about tech that we're always talking about, what other kinds of opportunities, whether it's groups, thoughts on, what you've already had to say about consumer spending, the impact that might have, where else should people be looking?
Yeah, I think financials are great here. I think you're looking for a steeper curve. I think the short end could come down a little bit and the long end can stay where it's at. I think capital markets activity is going to be buoyant. I think there's a lot of M&A opportunities in the regional banking sector. I think that we've had less banks over the last few decades, and I'm expecting that trend to continue. So that's one sector that I like. I also like energy. The majors have been doing well from a profitability perspective despite oil prices. I consider them to be near their bottom here around the $55, $60 range. So I like those two sectors. As far as the small caps, I got to agree with Ed. I don't like them here because they have a narrow path to advancement. They require a growing economy and rate cuts simultaneously. We have the former, but we don't have the latter. With the CPI here at around 3%, real-time indicators showing that it's going to stay there for the next few months or so. I think that's going to really quell the enthusiasm of fixed income watchers in terms of rate cuts for next year. Even though we have a strong economy, without rate cuts, that sector doesn't work. So yeah, financials, energy, those are my picks.
Perfect. Well, obviously, you're both joining me here because we're fortunate to have you coming to the Money Show Masters Symposium in Sarasota this December. Really excited to talk in person there. Just for anybody watching this, maybe with you first, Ed, could you give a sneak peek at the kinds of topics you think you're going to cover or what somebody's going to take away from seeing you there?
Well, I've been talking about the roaring 2020s since 2020. Back then, it looked kind of delusional that the decade ahead could be a really good one. Pandemic had just hit. We had the lockdowns. But I really believe that there would be a structural changes in the labor market that leads to shortages in labor, particularly skilled labor, a lot of skills mismatches, and that technology was coming to the point where it would allow companies to increase their productivity. I didn't really know that AI was going to be a big deal, and as it has turned out to be, I thought there were a lot of other technologies, and still believe that companies will do quite a bit to improve their productivity. That means better growth, lower inflation, good profit margins, and rising real wages. So it would be certainly a roaring 2020 scenario, but at the same time, I'll try to be balanced and indicate, okay, what could go wrong? I'll talk about the debt crisis that people like Ray Dalio have been warning about for a while. I'll look at some of these issues with tariffs. Between now and then, the Supreme Court may rule that tariffs are unconstitutional, which could really create some volatility in the markets between now and that ruling.
Got it. Jose, same question to you. I know we're still about a month out. Anything that you think is going to be important for somebody to take away or some of the things you probably plan to be talking about there?
Absolutely. So my title for the presentation is Bullish Through the Decade. I think that's similar to what Ed just said. Once you have this administration in Washington that's very, very supportive of Wall Street and of economic prospects, we're talking about policies like that are really set to start to benefit markets next year. You have a government reopening next year, hopefully, fingers crossed. You have lighter taxation, milder regulations, subdued energy costs, pro-growth ambiance in Washington, and that's really going to be very supportive for markets through the end of President Trump's second term. Employment, it's AI isn't out there taking jobs. We've had a labor quality issue since roughly 2015, 2016. This is employers responding to the fact that they don't have the capable workers needed to perform the tasks that they want. That's really, I'm going to talk about how AI is filling that role, talk about how immigration restrictiveness is, capping payroll growth, but not necessarily going to weigh on the economy all that much. Also going to talk about prediction markets and their rise. Here at Interactive Brokers, they've been a significant growth driver. We just spoke about them on our earnings call. In fact, we have even predictions on what Ed was just talking about. Will the Supreme Court allow the tariffs to continue under President Trump? as well as elections and other things. So looking forward to seeing you all there.
Perfect. Well, listen, I thank you both for joining me here. Viewers, if you watch the segment with Ed and Jose, they are going to be joining us for that Money Show Masters Symposium in Sarasota. It's actually December 1st to 3rd at a new venue this time, the Ritz-Carlton downtown. If you've been to Sarasota before, it's right on the bay. It's beautiful, lots of things to do when you're not listening to presentations that are hopefully helping your portfolio. Ed, Jose, thank you again for joining me, and I will see you in a few weeks.
Absolutely.
Thank you. Great to be here.